All right, welcome to the live stream. Be the boss of your money. Thanks so much for joining me. Happy Monday. Got a couple of things to run into. Just a quick summation. Stocks have been weak pretty much for a good chunk of the end of July, second half of July, heading into August. August and September are known to be slow months or negative months for the stock market. A lot of people think October is the worst month, but it's actually September historically is the worst month. October's had some of the notable swoons, like the crash of 87 and some other notable downturns, like the Great Recession. The stock market bottomed in March of 2009, but October does have a couple of big doozies to it. But anyway, we are in what's historically the worst time of the year for the stock market. Now, that doesn't mean that things have to be terrible. It doesn't mean that things have to go south. A lot of spam. I get about 100 spam calls a day, but we'll have to figure that out another day. So things have been weighing down. Retail sales have been stronger than expected. Inflation figures, while encouraging that they've come down a lot from the recent peaks, they kind of went down and just stayed down where they are, but they're not going lower. And now it looks like the hard part of fighting inflation is only just begun. Labor is still very strong, and we will continue to watch that. A worry now is that we get inflation down now, but it comes roaring back in the middle of the next year. This is something that happened repeatedly in the 70s when Arthur Burns was the chairman of the Federal Reserve. He would raise rates, inflation would go down, he would cut rates, and then inflation would surge, and the Fed just kept lowering rates prematurely. Paul Volcker came in 81, and he jacked up interest rates to incredible highs that people said were unprecedented, would never happen. He put the economy into what we would consider at this point a mild recession, but for manufacturing, it was a brutal, brutal time. It was also a time of rapid globalization, moving manufacturing production to Mexico and China. In any event, inflation came down, and it basically stayed pretty tame for about 40 years. And now here we are, inflation roared back up to almost 10% a little bit over a year ago. And I said almost 10%. I didn't say it hit 10%. And we're back down to running around 3% on the consumer price index. The Fed wants to see it at 2. That might be too much to expect. However, instead of raising rates, it was expected that the Fed would leave rates where they are, roughly 5% to 5.25% on the federal funds rate. Now they're thinking, well, we have 4 more labor reports, payroll reports coming up this year. We'll talk about that in a moment. We only have 3 more meetings with the Fed this year. The Fed meets every 6 weeks. They're meeting in September. They're meeting in November. They're meeting in December. And that's it. That's it for the year. A lot of people think that when we get into 2024, the Fed's not going to want to raise rates because they don't want to come off in any way, shape, or form as looking like they're partisan. And it's going to be a very political year. We've got the elections in November of 24. So the Fed does, if they're going to do something, it's expected that if they want to get in another 1 or 2 rate hikes, they're going to have to do it pretty soon. That is the current betting. I don't see where people think that inflation could rise rapidly next year. If it does, then someone's going to say, I was right, I told you so. If it doesn't, there are plenty of people who are going to say, I told you it wouldn't happen. We don't know. The Federal Reserve doesn't know. They just want to make sure it doesn't happen by keeping rates higher for longer and maybe raising them a little bit. So that's the lay of the land, and everything is about interest rates, and everything that you hear about that's bad, or good, depending on how you look at it, is the ball of wax for interest rates. So this is a big week. You know what? I have to roll the intro, which at this point is probably not much of an intro, so let's call it a middle row. But if you have any questions about the content we're talking about today, please hit me up in the comments. I love hearing from you. If you want to just offer words of wisdom, a shout out, a big hello, I'd always appreciate that. Give us a like. If you're watching on YouTube, please subscribe. Here's the intro, and then we're going to get into the top 5 things that we need to know today, including NVIDIA, reports on Wednesday after the close. Mortgage rates hit 7.48%. And Friday, September 1st, we have the payroll figures, which is going to be a very pivotal moment. And this Friday, we have the central bankers meeting. The global central bankers are all meeting in Jackson Hole, Wyoming, and we're going to see what the Fed has to say. Usually the chairman of the Fed is notorious, whoever it is, to saying things that could either help or hurt investors. So we'll get into that right now. All right, just a quick rundown. Dow is off barely 36 points. NASDAQ had a big up there, 1.5%, up 206 points. S&P up barely. It was up 9. It was up 0.7%. Not a huge, a good day, but not enough to make up for the down month, and not enough to help the market going down for the last couple of weeks. We're in a multi-week downturn right now. Oil at $80.90. We'll call it 81, barely moved. The 10-year yield, the 10-year bond is at a higher rate now. It's probably the highest since maybe, 2002. Mortgage rates surge. I think this is a story that's not getting enough coverage. The 30-year, this is an average. Now, you might be able to get a mortgage for lower, depending on where you shop, depending on your credit score. This is just a national average. 7.48%. So let's call it 7.5%. My first house that I ever bought was in 1995 in Jericho, New York. And the mortgage rate I got was 7.9 or 8%. And at the time, that was considered a pretty good deal. But mortgage rates were dropping a lot and they kept going lower. The rest is history. So we shall see. But for now, it's not really hurting it's not really hurting the housing market, because there is no housing market. There is very little going on. And I was just out with a mortgage broker friend of mine recently, and I worry about some of my mortgage friends, because I don't know how they're going to be able to stay in the business without any sales at all, because they all tell me there's nothing going on. No houses are moving. There's a few buyers out there. A lot of those few buyers are cash buyers, so nobody needs a mortgage for that. So it's the economy is good and labor is in pretty good shape, I guess, except if you're in a business that relies on financing. Okay, so having said that, let's go on to the 2 big things this week. NVIDIA has gone up a lot because of artificial intelligence, enthusiasm for NVIDIA's chips. For a server to become, let's call it, artificial intelligence capable, it needs a CPU. Let's think of like a really good CPU from Intel, Core, Pentium, whatever chip from Intel. And that'll take about 8 to 10 chips from NVIDIA. And these chips from NVIDIA are very expensive. They're about $45,000 to $50,000 a piece. And right now, NVIDIA has much more demand than supply. They just can't pump out these chips quickly enough. So as a result, the stock has tripled this year. And it's the market cap. I don't think a lot of people realize this, but it's probably the 3rd largest publicly traded company now on the exchanges. It's a little bit over $1 trillion market cap. The stock surged today. It surged over $30 a share. It had about let's call it an 8.5% gain today, up $36 a share today. Almost back to its year high just from one good day. Now it is let's call it $1.1 trillion. Earnings are coming out Wednesday. A number of analysts have upgraded the stock. Today, HSBC says it could go up 80% from here, which would be a massive move. That would put it at about a $1.9 trillion company. Maybe it happens, but maybe you get to a point where the the where the enthusiasm is baked into it. I'm just looking at some charts here. Earnings per share current earnings is 244. Forward PE is about 51. Not a cheap stock. You're paying for growth. And if the growth ever slows down, you're going to see it reflected in the stock. Remember, valuation is not a reason for a stock to go up or down, but valuation determines the magnitude, the size of the up or down move. So a stock that's highly valued or overvalued could keep going, but if it does have a down day, it'll probably be a doozy because of the valuation. But the valuation in and of itself, generally speaking, is not the determinant of price direction of a stock. You should know that, and I want you to say that again. Say that 10 times. Right. So Jackson Hole. So anyway, NVIDIA's earnings are coming out Wednesday after the close, and we're going to see if this massive enthusiasm is justified or not. Their last quarter was one of the most breathtaking corporate quarterly announcements in the history of the stock market, and we'll see if they could do it again. I do think they need to come up with something big, something bold, or else I think the stock takes a nice little hit. You'll have a chance to buy the stock cheaper. If they can really blow it out, it'll just reinforce that is the new must-own stock, just like Apple has been for the last 10 years. The mantle goes to NVIDIA if they can really pull this one off. So we'll see, but we're going to know in less than 48 hours. So it's going to be exciting to watch. Friday, the Jackson Hole, Wyoming meeting. Central bankers from around the world meet at the Fed-sponsored, paid-for central bank symposium. The Federal Reserve hosts this at Jackson Hole, very high-end hunting, fishing lodge, and I'm sure there's some golf there too. But Chairman Jerome Powell, Fed Chair Jerome Powell, speaks Friday, and investors are on the guard or on the lookout to see if he's going to come up with some kind of policy initiative or his own view of the economy, things like that. And that could potentially be market moving. The following Friday, September 1st, is the unemployment figures. That's when we get things like hourly averages, average hourly rates, pay, how many hours employees worked per week. We get the official unemployment rate. We get a lot of news. So we've got a lot of news coming up in what's typically a light time for the stock market. So this could potentially be market moving, and we're just going to have to wait and see. But it looks like investors have taken their bets. The market got down far enough, and investors decided, I'm willing to buy a little bit here before all these big announcements come up. So the question I get all the time is this: should I buy? You could fill in the gap with either Advanced Micro Devices, Marvell, or NVIDIA. These are all semiconductor companies. NVIDIA has about 90% market share of chips that are used for artificial intelligence applications, with Advanced Micro Devices and Marvell trying to break in and capture some more market share. Even if NVIDIA loses market share, the pie is growing so much that nobody's going to actually shrink. It's a growing market. But my point is, NVIDIA is about, let's say, 3% of the S&P 500. And in a hypothetical investor that has an S&P 500 index fund only, now you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. But if a hypothetical investor only has the S&P 500 index fund in his or her portfolio, you would have to ask if you have enough NVIDIA to buy more. Right? Maybe if you're thinking about buying more. So if you want to pick up Marvell, and if you want to pick up Advanced Micro Devices, you really have to ask yourself, are you building a portfolio that looks like this? Microsoft, Apple, NVIDIA, Netflix, Meta, which is Facebook, Alphabet, which is Google. And what happens is people coming in here to my office, I look at their prospects, I look at their account statements, and it's just tech company, tech company, tech company, tech company. And they're all teched out. And I've seen this enthusiasm for technology before. It was 99, it was 2000, and people got just absolutely destroyed when the tech market tanked. And we don't know if that happens or not. I don't want to become off like a negative prognosticator, like, oh, that doesn't sound confident, right? It's not a matter of sounding confident. It's a matter of you have to live in a world of probabilities. Some probabilities are low that the NASDAQ, I think it's a low probability that the NASDAQ goes down 80%, but I've seen it happen before. So what we need to figure out is, do you need more of a particular stock? If you're going to buy Apple or Facebook, if you have these other tech stocks, they pretty much all trade the same. They go up and down together. So when you look at a portfolio, are you looking to bring diversification, or are you looking to supercharge it? If you're looking to supercharge a portfolio, you have to load up more on what's working, which is large cap technology. In spite of the last 2 or 3 weeks of tech stocks going down a lot, they are still big winners this year. So if you have an S&P 500 fund and that's all you have, and then you add some of these tech funds, you're probably doing you should be doing it very well this year. But if the sector falls out of favor, not only are you very exposed to it with the index fund, now you've added some extra individual stocks to give yourself even more exposure to it. So that's why it's important to ask the question, how much of your portfolio should be dedicated to a particular stock? And quite often when people buy individual stocks and they have exchange traded funds, they have no idea. If you ask them, well, what's your allocation toward technology or allocation toward a particular stock? And if it sounds too high, in most cases, I'd say almost every case, it is too high. You have too much in one sector or one stock. That's the kind of thing that a financial advisor does for you, that they look out for. And if you want to reach out to me direct, check out clientfirststrategy.com. See if you want to sign up with us, maybe become our client too, and we could take it from there. Thank you so much for watching. I'm going to get going, and I hope you all have a good day, and we'll see what mortgage rates do tomorrow. And I almost missed it. We have Robert, I think it's Melzi, or is it Meltzer or Melzi? How often are the metrics used to measure the economy audited? They are audited pretty soon after they come out for the most part. That's why when you get, for example, GDP comes out, you get I think 2 revisions in GDP. Most economic statistics are revised pretty soon after they come out, and that's very common. And I've seen little quirks and things that have changed with how the Labor Department looks at their numbers, and if they find something that should be changed. Once in a blue moon, a government statistics office, will actually change the numbers that they have going back years, often over a decade, to make sure the numbers are historically relevant to the present day. I hope that answers the question, but they are looked at a couple of times, and I would say that is pretty much the form of an audit that they do. All right. Thank you so much for asking, and I will speak to you guys tomorrow. Have a very good rest of the day.